Greetings, members one and all of the Salivation Nation. What happened to gold and silver today? That's probably the question many of us are asking because they were hit hard. That's for sure. Gold is down to 1278.90 according to Kitco here. Silver is down to 1653, down 60 cents. Platinum is down $19 to $885, and palladium is dropped below the $1,000 level at $983. If we look here at gold price, it's much the same information here, slight variation, but very interesting indeed. This is an article from Gold Bulls Whipsawed that talks about what has happened, and some of it should really not be much of a surprise, but other aspects of it may. In Wednesday's highly anticipated FOMC meeting speech, the Federal Reserve took a slightly more hawkish policy tone in signaling 2 more rate hikes by year's end. However, the gold complex chose to focus on the Fed's rather tepid view of inflation, as Fed Chair Jerome Powell pledged to keep rates low enough to bolster the economy for some time and signaled it would tolerate above-target inflation at least through 2020. Despite policymakers projecting 2 more rate increases by the end of this year compared to 1 previously, gold remained firmly above $1,300 by Wednesday's close. I should also note that part of the reason for that is because these rate hikes are kind of baked in to prior levels and price movements before Wednesday's announcement. Next up on the central bank calendar the following day was the European Central Bank meeting, which was held in Riga, Latvia. After the conclusion of the meeting, ECB President Mario Draghi proclaimed the opposite of U.S. monetary policy strategy when he stated there will be no move on rates at least through the summer of 2019. Draghi also specified the quantitative easing program will stop at the end of the year. After the statement was completed, safe haven capital rushed into both gold and the US dollar as the euro sank nearly 2% on the day. And that so that basically means that it gave strength to the dollar, which kind of helped, gold prices go down. Since mid-April, the stubbornly strong world reserve currency had been keeping the technically oversold gold price from launching a rally. However, yesterday's surprising strength in bullion, along with the surging dollar, gave new hope for the gold bulls. But a stunning reversal this morning has gold speeding towards support at $1280. The gold price back-tested its 200-day moving average around 1308 yesterday, and the sharp reversal from this important technical line does not bode well for the short term. In order to remain near-term bullish, the gold price needs to hold the 1280 region, or we could see a quick trip to the 1260 area soon. The GDX has continued to hug its higher trending 50-day moving average for the past month and has been trading between $21 to $23 since early February, historically low trade-weighted volume. As mentioned earlier, the weak minor ETF has been setting up for a near-term break in either direction in the past few months and has been trending higher since it's bottomed on February 9th. Nevertheless, if the sudden reversal in gold does indeed break 1280, the low in GDX just below $21 could be tested soon. So it's quite interesting to see what's happening. Most of you know I posted an article yesterday about how within 30 days we're going to see a breakout with gold and silver. And will that still happen with this happening? Well, it's less likely if things continue, especially if they really test that 1280 part. We'll see it's just below 1280 right now. So it could go down before it goes up again in these summer months. So that 30-day may not happen because that's right in the thick, in the heat, in the humidity of hotness of the summer doldrums. And as most analysts are predicting that scenario for the juniors as we head into the normally slow months of July and August. And it's my contention that the normally slow summer period in the sector began earlier this year, while many juniors have already reached out to levels that beginning to form significant lows. Historically, after the miners have made a significant bottom, the juniors tend to lag before joining the rally. Recently, there have been many quality junior resource stocks being sold by impatient investors, creating opportunities for speculators with cash and patience. It takes a lot of time and effort to find these opportunities, and it's best to be on the hunt for them when the gold space is out of favor. When the sector turns, the stock prices and the quality issues move up quickly. So if you require assistance in jumping to the best quality juniors to invest, and so to stop by Junior Monkey, it's a subscription service trying to sell something, a contributor from Kitco. But nonetheless, ignore all that. Basically, I think this commentary is quite fascinating, though giving us some of the reasons why the prices went down. And I concur with that aspect of what they're saying, David Erfel's saying here. I think a lot of it has to do with the ECB announcing a stop to the quantitative easing program. And of course, the question is it really a stop of the quantitative easing program, or is it just a lessening of quantitative easing? In other words, they're probably still going to continue to print money, just not at the rate they're doing now. So in other words, quantitative tightening is a term that's been thrown around to describe as such. Post your thoughts below about today's prices, and with the prices dipping where they're at, are you going to take advantage, or can you take advantage? My suggestion is if the prices dip down, if you can't afford to make a purchase, don't do it. It's better to make a purchase when you have extra capital from which to spend when the prices are up, than in the other way around, when the prices to crash and dip like this, and to take advantage of it. If you can't afford to do so, don't do it. Post your thoughts below. I'd like to extend a multitude of gratitude to y'all for watching, and encourage you to please rate, comment, and subscribe.